Okay, hello everyone. So in the previous video we were solving this question number 17. Those who have not solved it, you can pause, solve it by yourself and then come back. We had completed variable overheads part, variable or variances. Now we have to calculate fixed overhead variances in this video. Okay. First we'll revise fixed overheads formulas as well. Then we'll go to the question. Okay. So again, just like variable overheads, for fixed overheads also, first step should be SRR per unit and SRR per hour. You should always see if this is given or you have to calculate budgeted overheads upon budgeted units or budgeted outputs and budgeted overhead upon budgeted hours. So standard recovery rate per hour and per unit. Fine. Now let's calculate fixed overhead variances. First is fixed overhead cost variance. Now concentrate carefully. What we'll do is, along with this chart itself, we'll solve this question. Okay. So for this question, let us see what is SRR first. SRR per unit and SRR per hour. Now I'm erasing all this. Now this is only about fixed overheads, forget about variable overheads. For fixed overheads, SRR per unit is budgeted overheads upon budgeted output. Budgeted fixed overheads are what? 45,000. Budgeted output is 30,000. So 45 upon 30,000, that is 1.5. Similarly, SRR per hour will be 45,000 divided by this 30,000. That is also 30,000, right? Hours, budgeted hours. So SRR per hour will also be 1.5. Okay. Now fixed overheads cost variance formula is exactly the same as variable overheads. So fixed overheads cost variance is what? SRR per unit into actual output minus actual fixed overheads. Okay. This standard minus actual, absorbed minus actual, that's it. Absorbed cost minus actual cost. So SRR per unit is what? 2. Actual output is given to us. Actual output is what? Sorry, not 2. 2 was for variable overhead, I'm sorry. 1.5 we just calculated. Into actual output is what? They have given to us 32,500, right? Minus actual fixed overheads, they are also given to us. Fixed overheads actual are 50,000. Okay. So check how much this is. 32,000 into 1.5 will give us 32,500 into 1.5 is 48,750. So 50,000 is more, actual cost is more. Actual cost is more, that means this is adverse. So 1250 adverse. Now I have told you this in variable overheads part also. There is a formula for conversion. How to convert hours to units. Actual hours will become standard output in actual hours. Standard hours will become actual output. Okay, standard hours for actual output. So when actual becomes standard, hours become output. Actual becomes standard, hours become output, or reverse way also. And budgeted hours can be easily converted into budgeted output directly. No need to do anything else. Okay. Fine. So using this, we can convert this formula to another angle now. SRR per unit, we can write it as SRR per hour into actual output will become standard hours. Actual will become standard, output will become hours. So standard hours for actual output minus actual fixed overheads. SRR per hour is also 1.5 into, let's see what is standard hours for actual output. Let me calculate them here. Very important figure. Standard hours, how to calculate them? Always remember, budget is where we get standard data. Why? Because when we prepare budget, we will obviously prepare it as per our standards, right? What we want. So standard data we can get from budget. Now, as per budget, what is hours and units ratio? Budget is saying that 30,000 units and 30,000 hours is the ratio. So now we want standard hours for actual output. What is our actual output? 32,500. So can you tell me for 32,500 how much should be standard hours? Right? This is a simple ratio. This upon this is equal to this upon this. So can you calculate how much is it for 32,500? Check if it is 32,500 only. Standard hours for actual output 32,500. Okay. Very important figure, we'll need it many times. So 32,500 minus 50,000 If you observe, it is same as above, so that is going to be 1250 adverse. Okay, fine. Next, there are two parts to this formula. Fixed overhead absorption can change because of either change in fixed cost, which is called as fixed overhead expenditure variance. This is change in fixed cost, or absorption can change because of change in number of units. So this is called as fixed overheads volume variance. Okay, this is due to change in total cost. This is due to change in absorption of the cost. Okay, I'll explain the logic behind this in some other video, because understanding the logic is very important from exam point of view, so that you are able to solve the questions very quickly. Okay, fixed overhead expenditure variance. Easiest formula: budgeted fixed overheads minus actual fixed overheads. That's it. So budgeted fixed overheads are what? 45,000. Actual are 50,000. So 45,000 minus 50,000 will be the answer for this. So that is 5,000 adverse. No need of any other formula for this, because budgeted will remain budgeted if we convert, right? Fixed overhead volume variance. Now volume is output. Okay. Understand, this variance is not the difference between standard and actual. This variance is difference between budgeted and actual. Okay. Into obviously SRR per unit. Why? Because absorption is based on budgeted output, not standard output, right? When do we do absorption? When do we decide absorption rate? At the beginning of the year, when we have budgeted figure, and at the year end we will get actual figure. So volume variance is between budgeted and actual, not standard and actual. So what is our budgeted output? They have directly given 30,000. Actual output is 32,500. So into SRR per unit is 1.5. So let's see how much this is. 2,500 into 1.5. 3750, right? Now concentrate. This is where many students make mistake. 3750 is negative, but actual output is more than budgeted output, which is good. So this is a favorable variance. This is a favorable variance because actual output is more than budgeted output. So volume variance is opposite to all the cost variances, because volume variance is about output, cost variances are about expenses. Okay, more output is good, more expenses are bad, right? Fine. We can use another formula for this also. Let's try another formula. SRR per hour into budgeted output will become budgeted hours. Like I said, budgeted will remain budgeted in this box. Okay, and actual output will become standard hours for actual output, right? We already have calculated this. 1.5 into bracket. Budgeted hours are 30,000 and standard hours we have calculated 32,500. Sorry, 32. How much is this? 2,500 into 1.5, again 3,750. Now this is negative, but still this is favorable because we have done nothing but converted output to hours. That's it. Okay, volume variance is finally divided into three parts. What three parts? First is fixed overheads, calendar variance. This variance will come only if number of days are given, otherwise not. Then we have fixed overheads capacity variance. Then we have fixed overheads efficiency variance. Remember, calendar and capacity are just bifurcation of capacity variance only. So this is all related to capacity and this is related to efficiency. Why is this important? Understand. Again, capacity, more is good, right? If you use more capacity, more hours, then that is good. But if you use more hours, then that is bad for efficiency. Okay, for producing same number of units, if you use more hours, then that is bad. But if you work for more hours and produce more number of units, then that is good, right? So in capacity, more is good. in efficiency more is bad. Okay, so capacity is like this volume variance, so it is going to be opposite, whereas efficiency variance is like are all other normal cost variances. Okay. If it feels complicated, again I'll upload a video which will explain the logic behind all of this, but I hope this is good enough, because capacity is like volume, efficiency is like all other cost variances. Fine. Calendar variance, so just budgeted days minus actual days, that's it, into SRR per day. SRR per day will be what now? Budgeted overheads upon budgeted days, that's it, into budgeted days minus actual days. Let's calculate this. Budgeted overheads we have 45,000. Budgeted days, working days, we have 25. So what is SRR per day? 45,000 divided by 25, that is 1800. Into budgeted days 25 minus actual days are 26. So it will be 1800. Again it is negative, but like I said, we have worked for one more day, which is good, so favorable. One more day we have worked, so that is good, so favorable. This is capacity, not efficiency. Now capacity variance. Capacity variance is, now again we have to check how much capacity did we have and how much capacity did we use. It is similar to this, just instead of days we'll take hours and SRR per hour. The only thing that we have to do is concentrate very carefully. We have to take this budgeted hours for actual days worked. Why? Because we have already separated difference between days in this calendar variance. So now we have to take only actual days worked. So concentrate very carefully now. SRR per hour is 1.5. Actual days worked. First of all, budgeted hours are 30,000. But that was for 25 days, budgeted days, right? Budgeted hours were for budgeted days. So 30,000 was for 25 days. Now we have to see how much for actual days, 26 days. So can you just cross multiply 30,000 divided by 25 into 26, 31,200. So 31,200 is the budgeted hours for actual days worked. Again, if you have not understood, concentrate. Budgeted hours for actual days is what? This 45,000, this 30,000 budgeted hours were for 25 days as per budget. But now we have to take for actual days. So for 26 it will be how much, right? And minus actual hours we have 33,000, I guess. Yes, fine. So what is it? 2,700. Again, decide whether it is favorable or adverse. You have worked for more hours, so for capacity that is good, so favorable. For efficiency that is bad, but for capacity that is good, so favorable. Fine. Last is efficiency. Like I said, efficiency formula is always the same, always. Standard hours minus actual hours into SRR per hour. Always, whether it is labor, variable overheads or fixed overheads. So we have standard hours, we have already calculated somewhere, right? 32,500 minus actual hours 33,000 into SRR per hour 1.5. How much is it? 750. Now this is adverse because this is efficiency. If you take more hours, then that is bad for efficiency, right? Check if totals are matching. Favorable plus favorable minus adverse. Check. 1800 plus 2700 minus 750. 3750 favorable. Correct. Right. That's it. So this was fixed overhead variances. Like I said, a very complicated but very interesting concept. Once you learn it, in exam it is very scoring. Why? See, I have seen many students who skip standard costing, but that is not a good habit, because once you see, I agree that studying standard costing will take efforts, but once you study it, once you solve missing figure questions and something, then generally in every exam it comes for 10 marks. Okay, rarely it does not come, but generally it comes for 10 marks, and it is like you will definitely get those 10 marks if you have done this, because it is nothing outside SP, AP, SQ, AQ, SR, AR, SH, AH, and then this SRR. Nothing outside this. That's it. only these 10 12 variables, and every formula, every question is based on this, right? Fine. So I hope this is clear to everyone. If you have any doubt, let me know in comments or on Telegram. Okay, I've given the link to the channel in the description. So there I generally upload questions every few days and discuss them. Okay, fine. Okay, then let's stop. Bye everyone.